Hi there, I'm Champion Trader Kevin Davey, and today I'm going to talk to you about how to improve your algo strategies by 26.7%. Not 26.6, not 26.8, but 26.7. You'll see where that number comes from as we get started. First, our disclaimer: don't trade with money you can't afford to lose. Treat all results as hypothetical, and past performance is not indicative of future results. So remember all that. Okay, before I get started, first, if you don't have this free crude oil algo that I give away, go to the description and you'll see a link to my website where you can sign up and get this free crude oil algo. I started giving this away in 2022, so almost 2 years ago. Have not changed the code at all, and you can see how well it's performed in 2023 and so far in 2024. So it's a pretty neat algo. You might find it useful. Just go to my website and you can sign up for it. And by the way, there's just one of the recent trades that it made in March. And you can see it has some losing trades, which all algos do. And then it caught a fairly decent winner. So take a look at that. All right, so let's go back to what we're here for. And what I'm about to show you is based on statistics, hard data. So I don't like to tell you to do anything that I don't have data to back it up with. And there's a lot of people out there who will say, oh, well, use Fibonacci's, use trend lines, whatever. And they never show any kind of results or data to back it up. What I'm going to tell you today, this has hard data to back it up from hundreds of strategies that I've analyzed. And how did I do that? Well, a lot of the strategies I got from what I call the Strategy Factory Club. It's for students of my course. And real quickly, what they do is they submit strategies that they create to me. I evaluate them during a 6-month live test. So they've already back tested and said, hey, this is a good strategy. I then run it live for 6 months and judge if does it meet the performance goals it should meet. And if it does, then those strategies are shared among students. And this is an exclusive benefit of my course. But with this club, I get to see a lot of strategies. And so what I do sometimes is take those strategies and do some analysis of them. And that helps all my students get better. So the question I was trying to answer with strategies I looked at for this study was, hey, let's say you take an equity curve for a back test and you eliminate a certain percentage of the most profitable trades. Okay, so now you have a different looking back test. Does that tell you anything or imply anything about what the future live performance may be? The short answer is yes, and that's why we're here. So let me give you 2 examples first and show you exactly what I'm talking about. Then we'll dig into some of the details. So here's strategy A. And the orange equity curve up at top is with all the trades in the back test. And you can see it's a pretty decent equity curve. It has ups and downs, but it's up and to the right and kind of angled. That's what people look for. Has about 400 trades. So pretty nice. But if I take away the best 5% of the strategy trades, I should say. So I take away the best 5%, the most profitable trades, then I end up with the green equity curve. Yeah, you might say, it's not so great. So it went from before to after. Strategy's not so good once you take out those best 5% of trades, which is only about 20 trades. So you eliminate 20 trades and look what happens to your equity curve. And if this was a 10 to 15 year back test, which a lot of back tests that I create are, then you're talking 1 to 2 trades a year. All you're eliminating is 1 to 2 trades a year. And that's what happens to your equity curve. So that's not so great. But let's take a look at another strategy. This is strategy B. And you can see the before and after of eliminating the best 5% of trades, the most profitable 5% of trades. And that one looks a lot different. You know, the performance still comes down when you eliminate those best 20 trades or so. Again, this has 400 trades in it, so it's pretty similar to the last one. But overall, the strategy still looks pretty good. So, does that matter for real-time performance? It's a theory, right? You know, does strategy A, maybe it performs better than strategy B because of this tendency with big trades. So I took a look at it, and on this one, strategy A, when you took away those best trades, it had poor performance in its backtest. And then when I ran it live for 6 months, which I don't show you in the previous charts, it did pretty bad. It lost quite a bit of money. Where strategy B looked pretty good after taking away the best performing trades. And in real time, guess what? It looked good. Now that's a sample of 2, right? Or one good one bad one. So I had to analyze hundreds of trades before I could draw any conclusions, and that's what I did. And what I found is if you eliminate those most profitable trades, a certain percentage of them, the example I gave was 5%, but you can use other ones, and I used a different value, a smaller value for my study. But if it causes a quote-unquote significant drop in performance, then the first 6 months that strategy's live, it's more likely to not perform or to fail. And in fact, the difference is about a 25 to 30% improvement. You know, I gave you a hyper-specific improvement last time, and that was based on all the strategies I looked at. So I looked at hundreds of strategies. I found out ones that I categorized as bad, meaning you take away those most profitable trades and the strategy doesn't look so good. 42.6% of those passed that 6-month performance test. But when the strategy was good after removing the most profitable trades, 54% were passed. So it went from 42.6% to 54%, which is like a 26% improvement. And that's where that number came from. So you get quite a few more strategies to look good if you just stick with the ones that look good after removing some of the most profitable trades. Okay. So the big advantage here, and I think the reason it works, is I think your equity curve's a little more consistent. You're not relying on those outlier trades to give you those big profits. Because like I said, they only come maybe once, twice a year. So this one, you're probably going for smaller profits. So maybe strategies that have a profit target fall more into this category, where the ones that fall apart, the strategies that tend to fall apart, go for huge trades, and they come pretty often. And that's the big disadvantage of this approach, is you'd be giving up some of those big win type strategies, you know, where maybe you have to go a couple of years and then all of a sudden you get a huge win. So you got to ask yourself, would you rather have some more consistency, or would you go for those big wins? And that's a personal choice. I mean, there's hedge funds out there that specifically target those big wins. They call them black swans, the outliers, because they're so profitable. But maybe for consistency purposes, you want to stick with the smaller wins. Okay? So it's something you can try. So how do you implement this? Okay. So you calculate your performance with your original strategy with all the trades. Let's call that X. And when I say calculate performance, maybe it's net profit, maybe it's max drawdown, whatever objective metric you want to use. I use a specific one in my course, but you could use a bunch of different ones. And so you first calculate whatever that metric is with your original strategy. Then you eliminate the top percentage of strategies. Could be 1%, could be 5%. You eliminate those most profitable trades and then calculate that same metric and call that Y. Then you just take the ratio of them, Y to X. And if it's above a certain amount, and you'd have to review your strategies to find out what that amount is and look at your real-time performance, then the strategy is still good. So what I did when I ran my study is I had that 6 months of data, and so I knew where to set the thresholds, and I knew where to set these values and what parameters to use and everything. So I share all of that with people, traders who take my course. But if you want to do this on your own, that's how you would approach it. Okay, so with that, the question again was, does eliminating the most profitable trades in a backtest tell us anything about future performance? And the answer is yes. If you eliminate profitable trades and your equity curve still looks pretty good, then your strategy is likely to perform well, at least in the first 6 months after you develop it. And the first 6 months is pretty important because that's when a lot of people tend to abandon their strategies. Okay, so I hope you like this. Hey, don't forget my YouTube channel, which is where you're at now, but I have tons of other videos. And don't forget to visit my website. I have a lot of in-depth articles. Please subscribe, hit the like button, and leave a comment. Let me know what you think. I'm curious. I'm Champion Trader Kevin Davey. Have a great day.